We've been talking about the MFI space, and we've been talking about the MFI space in terms of how the stress now seems to be coming back into the MFI space. For the quarter gone by, the numbers were not looking all that encouraging. For the quarter gone by, it was perhaps evident in the way how things have moved and things have progressed. So let's take that conversation forward. Shah, Vice President with IIFL Securities, joins us now, and let's understand how deep is this problem in the entire MFSI space. Viral, good morning. Thank you for joining us. What is your sense? Is this like a long winter?
So, in case of MFIs, this is a winter that unfortunately keeps coming back after a few years periodically. I think we are still not out of the woods yet. Probably we are going to see, in fact, much more pain in the second half of this year. And if at all there are any hopes, probably from say the next fiscal is when we see things that they will maybe coming back to some bit of normalcy.
So is it priced in because some of these stocks have corrected, or do you think there's still scope of derating?
So see, what happens is in case of MFIs or any lender, right, if there is such kind of stress which say can result in losses, you will see hit to the net worth itself. So something that you may be seeing say at a 0.9 times or say a 0.5 times book, it may actually turn out to be say 0.8 or 0.9 or maybe 1.1, 1.2 times book if there is a hit to the net worth. Yeah. So our recommendation to clients is that it is still not the time to bottom fish yet. It's going to take some time, and in fact the pain recognition in the first half of this year, while we have seen the delinquencies and all those rising, but the pain recognition in terms of the slippages and the credit costs, they have been only to the extent of 10 to 12% of the total stress loan pool for all of these MFIs. So there is a long journey ahead in the second half of this year, and probably one should wait for that before one thinks of say a bottom fishing.
But how come nobody saw this coming? I mean, RBI has been talking about it in terms of the stress in unsecured book, and at that time everybody was like, RBI is being extra cautious, is there really a need of it? And then suddenly this, kind of break within this entire asset quality. Why did nobody see it coming?
So basically at the expense of sounding too pompous, I would say that we have been highlighting this stress since May and June of this year, wherein many of the lenders themselves, they were actually reluctant to call this out as a sector-wide issue. Things were being blamed on either elections or say heat waves and those temporary disruptions. We have been flagging this as an over-leveraging issue, which is a system-wide thing, and basically this is in the making since last 2 years. Since the time RBI relaxed the lending norms in May 22, we have seen that a lot of these NBFC, MFIs and also SFBs, I would say, they have been really aggressive in terms of pushing the growth. And unfortunately, instead of say going and acquiring new customers, essentially everyone was lending to the same customer. So that is what actually led to this over leveraging as an issue. And I think we are still in the midst of the crisis.
Just a last quick question to Viral. Give me the pecking order within NBFCs and MFIs. If you still had to make a kind of recommendation to bottom fish or the companies which are least vulnerable to these asset quality issues, which are the names?
So first of all, for me, I would say MFI is still a clearly avoid. I think, as I mentioned, the pain recognition is still to happen, which will happen in the second half of this year. Amongst the NBFCs, the pecking order for me would be the relatively more diversified ones. So you have vehicle financiers who are typically viewed as vehicle financiers, but like someone like a Chola, who's now a much more diversified lender. Probably now I think even a Bajaj Finance looks attractive at this price point. And someone who is making a journey from being a vehicle financier to a more diversified one, someone like a Shriram Finance also after the recent correction looks attractive. That's what I would say broadly pecking order amongst the diversified NBFCs. And maybe even the housing finance companies, some of the ones who are where you have some valuation comfort may look good, especially given that if the rate cuts are pushed out in India, it's actually positive for the mortgage lenders.
Okay, we'll appreciate your time. So glad you could join us.